Oh, let's
Okay,
do it.
everybody, we're going live. Thank you.
Can you hear me? Hear me? I'm
Hi,
not hearing
Sean.
anybody.
Yeah, I hear you.
My
Morning.
I can
speaker
hear you,
is not
Sean.
working. It says, okay, I'm gonna have to log off and log back in again. Sorry about this.
It happens. Right. Oh, I can see you now. That's good.
Okay, 5, 4, 3, 2, 1. Good morning and welcome to the Daily Energy Markets podcast. It is the 3rd of September and Brent crude oil is trading at 77.34, down a little bit this morning in early Asian trade, with the reports from the news agency saying that Chinese weakness is trumping the sort of shutdowns in Libya or any other supply disruption concerns. China weakness trumps Libya shutdown. Let's welcome everybody back and kick off this morning with Adi Imsirovic, of course, sitting there in London, or more accurately in Surrey, Director of Surrey Clean Energy and Senior Associate at the CSIS. Adi, like you, the adults are back in the room. We've seen the Brent crude oil price over the last month, while the kids have been running the show, dropped to 76 in early August, up to 82, down to 76 in mid-August, back up to 80 again, and now back down again. All of this craziness through the month of August, is that all going to sober up now? Wall Street reopens today. Adi's back on the podcast. Let's go.
Absolutely. Well, good to be back, Sean. Thank you very much. Well, we had a fairly volatile August, which is kind of unusual because the kids, as you mentioned, don't tend to do too much. But obviously, the volumes were not that great and liquidity was not brilliant. And in such situation, usually you have a bit of volatility, on top of which we have had quite a few geopolitical events, developments in Palestine, obviously Red Sea, and so on. Not to mention, as you mentioned, Libya, a big one, really. I think I'll just go back to what you said early on about China trumping the Libyan situation. Well, China's been around. We know what's happening with China. I think the issue with Libya is that a lot of players out there know that the situation in Libya has been like this for quite some time. And in most cases, whenever we had these threats, whenever we had these discussions or who gets what money, at the end of the day, all the factions involved need the money. They all need the oil to flow. So the bottom line is that, the experienced hands in the oil market say, fine, yes, we're down, but sooner or later Libya will come back. So this is just temporary. And I think the market is seeing Libyan situation as quite temporary. And going back to fundamentals, and fundamentals are that China is really not performing. And not just that, I think situation elsewhere as well, outside the United States, Europe is not looking brilliant. And we'll have to see some major cuts in rates over here to get the economy going. Germany being obviously the sick man of Europe. And we can talk about that a little bit more if you wish. But, there's a talk of for the first time in 87 years, factory closures, car factory closures in Germany, unprecedented. It just tells you the extent of the fall in demand for ICE vehicles and competitiveness of Germany in sort of EV new sort of sector, which is really the EV sector, where China is dominating. So plenty to unwrap there. But overall, the situation, yes, is not looking brilliant. In spite of all the geopolitics, we are actually seeing oil being a bit of a laggard in the sort of investment sector. and that's probably longer term what's going to prevail.
Omar El-Baidly, Director of Research at the Bahrain Center for Strategic International and Energy Studies. Omar, try and make sense for us of the geopolitical backdrop to all markets, but most notably for our neighborhood, the energy markets, reflecting over the summer, big changes. It seems we come out of the summer with all of the hotspots extra hot. Your thoughts of where the geopolitics are and their impact or relevance for the energy markets coming out of the summer?
Well, last time I was on, just before the summer, there was a real sense that things would kick off between Lebanon and Israel. I think now, at that point, we were waiting for the response, from Iran. Hezbollah fired a few missiles, I think it was last week, had a salvo. There were some fatalities and there was a short reprisal. But for the time being, I would say that it looks like both sides have somewhat credibly communicated to each other that they don't want a big fight and that they've, for the time being, had their pound of flesh. So that's actually a decrease in tensions compared to where we were. But everyone knows that this is very fragile, and that's the main source of concern. And also in the, the brief GI circulated this morning, the Houthis are continuing their attacks on shipping, which could kick off at any point. So I think that compared to, the start of the summer, maybe tensions are a little bit lower, but in the Middle East, there still remains a great deal of tension regarding Gaza and southern Lebanon, especially because, with the US elections going on, Israel, in some sense, has a little bit more leeway to act capriciously, and Netanyahu has demonstrated on more than one occasion a tendency to react impetuously. And that really is what everybody's probably most scared about in the next, from now until the end of the year. Is someone going to press a reddish, if not red, a reddish button and drag the region into a horrific conflict?
Let's welcome Shoaib Boutamin, Energy Advisor and CEO of Ranadrill Consulting, sitting in Algeria. Shoaib, starting with, we've heard there from Adi, China weakness, Omar indicating while there's vulnerability in the Gulf and in the Middle East for geopolitical risk, at the moment, nothing is threatening oil supplies. So Libya and the rest of OPEC Plus becomes the sort of focus, if you like, as to where supply might go. Starting with the Libya issue, obviously geographically you're closest. I don't know if that means or translates into being closest with any knowledge or insights, but you're close enough to know that Libya has been through multiple tumultuous moments over the last decade. Is this just another one of those and it too will pass, or is there something more notable here?
Yeah, good morning, Sean. Good morning, everybody. I think that problem in Libya is really it's taken time now, just for more than decades. Our problem in Libya is there is a conflict. There is a spot between the eastern and the western parts. And the last time we had like a problem regarding the nomination of a new governor of CBL, Central Bank of Libya. So every part is trying to put another leader, another governor of the bank. So the problems in Libya, this blockade of many fields, several fields in Libya, is impacting mainly the local supplies of Libya. But what I believe that we didn't see the impact internationally, because these crazy geopolitical problems, let's say now we can talk about Libya, talk about the war in Palestine, in Gaza, they didn't really impact the global market, because there is a glut of supplies in the world, and these geopolitical problems or internal problems did not really get to absorb the glut in the market. I think that the time we will have a balance between offer and demand, and we'll have another geopolitical problem that time really we can see the impact internationally in the oil prices, because now we have a glut of production in the global market. So even we have those small problems, let's say in Libya, we have them in the Middle East, but didn't reach that level to impact the international oil and gas prices. Let's say if we talk about Libya, I think Libya is producing was producing more than 1 million barrels per day. But I think that these problems are taking, it's not really new. It's not really the first time that these troubles happen in Libya. But I believe that these troubles, they don't take a long time. So just week to week, 3 weeks. And I think that production, that they received instruction, the oil companies in Libya, to resume their production. I believe that the problem now in Libya and other regions is not really, as I said, is not really impacting the global oil market. Just I want to take note something very important. If we go to the Q3, let's say Q4 23, oil prices were just below $80. And the OPEC plus reductions cuts were only 3.66 million barrels per day. But today, oil prices are going back to lower than $80. And the OPEC plus is cutting let's say 5.86 million barrels per day. So we are remarked
and Libya, which is another 700,000 barrels.
Yeah, exactly. So we see the difference from Q4 to this quarter. We have difference of 2 million barrels, but the prices, the cuts, I mean, but the price is still the same. So it means that there is a glut of production of supplies in the globe, and that's why let's say the OPEC plus succeeded to cut 2 million barrels and kept the level of 80, let's say below $80 of oil per barrel. And this is very interesting point. I think we have to highlight.
Yeah. Adi, coming back to sort of the opening there, that obviously Wall Street returns to work today after the Labor Day weekend, the first Monday, or should I say Tuesday in September. So it's essentially the sort of first day back after the summer. Given all the things in front of us, and obviously we've had the Fed signal quite strongly now, they're ready to cut. We've got some data points coming this week. Where does the money go? What gets the attention of the particularly the funds looking at potentially going into the energy markets? Are they looking at this OPEC cut and maybe the increase of OPEC supply starting next month? Or are they going to look at the Fed decision? What do you think dominates the narrative for direction of travel?
I think the Fed decision is always carries a lot of weight on the oil market, but that news is already in the market. The only question is, how many cuts are we actually going to see from now on? So the cut was already in the market. What's really interesting is that what sets the flat price, what we call sort of $80 a barrel, is really the financial markets. Nothing to do with us lowly oil traders here counting barrels and moving cargoes around. So what is the key is what they think. And oil primarily, outside some speculation, is really a hedge for inflation. And I think the whole inflation story has, pun unintended, deflated. So it's not there anymore. So buying oil as a hedge against inflation is really sort of an old trade that's out of fashion at the moment. And I would guess that that's one of the reasons why we are seeing these the pressure on the oil market and prices, in spite of Libyan losses, in spite of OPEC still kind of trying to be in charge. And I think market is slowly moving also to the fundamentals of the fact that we have massive excess capacity out there. And the narrative that's actually coming back to the market again now that we are past third quarter, and let's not forget third quarter was the time when we all, including myself, expected to see a bounce in the oil price going into the $90 barrel. It never happened. So what needs to happen is basically that the narrative is changing very much, and we are going back to the narrative, well, what is OPEC going to do? The demand is not there, because OPEC is strong in a strong market, weak in a weak market. when demand is weak, OPEC has a lot of trouble. And that's why I think that's one of the reasons why OPEC decided probably to go ahead with this couple of hundred a month, more precisely 180 a month release or reduction in their cuts. So market is looking around, say there's plenty of excess capacity. OPEC is actually coming back with oil. So we've got more oil coming out. Libyan situation, as mentioned earlier on, is probably transitory anyway. China situation is long-term. It's really Chinese demand is peaking. Interestingly enough, US demand, gasoline demand is actually peaking as well. It hasn't been doing all that well. So the only thing that we have going in the oil market, margins are rather poor, especially in Europe, margins are dismal.
I mean, listening to you there, you think, oh, our price is even 76.
Exactly. So now we're talking about ceiling of 80. I still think there's plenty of oomph left in the market. I think China will probably come in spite of relatively high oil stocks. They usually like to do. Let's not forget we are buying November barrels at the moment. We are trading, and going into Chinese New Year, they always like to have high stocks. So I still think there's some oomph left a little bit in the market, but overall, when you look at the big picture, you can see why the prices are where they are. Really, there's not that much bullishness out there to come from.
Omar, just coming back to some of the points in your earlier comment, and again, where geopolitics could be one of those factors, as we've seen sporadically through the year, the last 12 months and 24 months or whatever time frame you want to pick, where it bubbles to the surface and becomes a spiking moment rather than a long-term hold in terms of a risk premium. But you said there that Netanyahu, given the American election cycle, has a window to be more reckless than maybe normal. But nonetheless, it would appear Iran is not biting on those moments in which they're prodded into reaction. And I just wanted to get your thoughts on that. Obviously, over the summer, since we were last together, we have a new president in Iran, a new president who is in the framing is referred to as a reformist. That generally means more friendly to the outside world as much as he can be, and so forth. So I wanted to get your thoughts on where this triangle is now going forward. New president in Iran, where is Saudi Arabia in this trifecta, and Israel as we go forward? Does Saudi-Iran counterbalance in terms of keeping things calm despite Netanyahu's prods? Your thoughts on all of those three pieces?
Well, first of all, I think that when it comes to Iranian retaliation, you have to remember that what Israel did was assassinate, a senior figure. And so Iran, first port of call will be to try to, return in kind. And so, there is a focus on their missile arsenal and their proxies and so on. But probably, and who knows exactly what's going on, what they're looking for is a window to assassinate some high-ranking Israeli official, which is not something, rather than, launching hundreds or thousands of missiles in a big salvo, into a civilian area or something like that. So if that is indeed the case, then it's going to probably take them a long time to find the right opportunity to respond in kind. And so we shouldn't have expected that to have happened thus far, and it could happen anytime in the near future. And in the meantime, they're probably quite happy to the Israelis sweat. And I know there was significant disruption to commercial flights in and out of. And civilian air flights in and out of Israel over the summer because of expectations of a potential. So they're probably quite happy with that situation from Iran, and sometime in the next 2 or 3 years we may see an attempted assassination, but who knows? But yes, I don't think we'll see the sort of full-blown escalation. And I don't think it's actually specifically related to the political party that's in the presidency, because whether you're a reformer or a hardliner, I think that having somebody assassinated on your home soil is something which is not acceptable. And so I don't think there's going to be any deviation from an Iranian consensus that some sort of retribution needs to be exacted. I think that Saudi Arabia, does have continued ability to influence Iran more than usual. But as I say, because of the expected nature of retaliation from Iran, I don't think it's necessary. Probably Saudi Arabia said, please don't, launch World War III. And Iran said, no, we're not planning on doing that anyway. And so that everybody's on the same page as it is. But again, as we've said several times on this podcast, when you have these large buildups of troops and when you have these, nervous and stressed out leaders, all it takes is one mistake and things can kick off, and that's, and we've seen that happen already.
Joy, the other point, obviously, that the markets are focused on now is we're moving into the first time in quite a long time where OPEC countries are adding new supply into the market from October 1st. There was some, and still you read, the sense of speculation, will they go ahead with it? But at this stage, it's like the train's left the station. October 1st is a few weeks from now. But your thoughts on that strategy sustaining through the winter? There's always a narrative from OPEC and OPEC leaders saying, we can always change course every month when we review. Your thoughts on the sustainability of this program that they announced earlier this year? The first month seems to be baked in. It's already, the train's moved on that one, 180 in October. But beyond that, your thoughts on OPEC Plus maintaining this program, which over the course of 12 months is to add 2 million barrels back to the market?
Yeah, I think it's very important from the market. If we talk about the market share, this is very important for the OPEC Plus to pump more barrels to the market, because we have to say that the U.S. production is flat since a year now. Last September, let's say October, in October 23, the U.S. production was like 13.2 million barrels per day. It's the same today. It's like 13.17, less than 13.2 million barrels per day. So what the OPEC Plus is looking is not only for the prices, I believe, but it's also to recover its share of the market share. Because if we see the U.S. now is not increasing production, this is a good point. It's good news for the OPEC to try to, let's say, to fill up the gap, because the U.S. is not increasing production. We have to say also that Chinese imports increased last August from, let's say, July, where the imports were 10.8 million barrels per day, and in August increased it to 11 million barrels per day. It's the same for India. The production, the imports increased from 4.5 to 4.8 million barrels per day. And this is a good sign for the OPEC Plus that there is, let's say, a good improvement of the imports from Asia. And why not? The OPEC Plus will take a seat of the market share. I think it's very important for the OPEC Plus to think also not about the price, but also about the market share. This is I think I appreciate that a lot. But the OPEC, I say, OPEC Plus decided to repump more barrels to the market, but there is no schedule. Okay, there is no schedule. It will pump 100,000 barrels per day, but we don't have what's really scheduled for the upcoming months. I believe this is a good step for the OPEC Plus to recover its part of the market share.
Adi, just let's go to the survey question first before we go to the last round of questions, which is, will the return of Wall Street business as usual with the end of summer, Labor Day, be bullish or bearish for oil prices? The return of Wall Street and all of the big money actors paying attention, will they be in a bullish or bearish mood for oil prices, or no impact? Your thoughts, cast your votes. Adi, just looking at Europe and again, another flashpoint, of course, is all things Ukraine. So I wanted to get your insights on that as well. But starting with Germany, we've had two sort of big developments there in the last few days. The result of the election, which for the first time has seen some major gains for the far right in Germany, which sets up for the general election a year from now. what your thoughts on that, and as you mentioned earlier, the economic malaise in Germany with the closure of a Volkswagen car manufacturing plant. Those events, not related obviously, but more stress for Europe's biggest economy.
Germany is a very good case that reflects what's happening in the rest of Europe. They're being hit by falling demand in Germany, in China, because China was a huge export market for Germany, especially German car manufacturers. Okay. Secondly, competition from EVs, and a whole thing that we usually don't talk in these podcasts is the green elephant in the room that we always kind of try and forget about. That is happening, and it's happening as we speak. The EVs are really coming big time to Europe in spite of large import tariffs.
So like you said earlier, peak oil demand in China, and gasoline may be going out of fashion.
Absolutely, and Europe's been there already. So the only little bit of demand is coming. I hear earlier sort of suggestion of growing demand, but I'm very, very skeptical actually, because everybody is hoping that demand is coming from India, but India is a minnow. India, when demand is doing really well, increases by 200,000-300,000 barrels a day. That's not going to replace the growth that we had in the past 20 years from China, where 1.5, 2 million every year came in. So we are going back to this situation where most of the oil is coming from non-OPEC countries. And all the oil from America is basically enough to supply the increase in demand for next year. So, and OPEC is now supplying their own, trying to fight for the market share. And this is where the danger for OPEC is. If they really are fighting for the market share, that means lower prices.
Does Germany's continued malaise and move to the right signal concerns for their appetite to support Ukraine as this conflict drags on into a third?
I don't think so. I'm no expert on German politics, but it seems to me that Europe has shifted outside the UK, has shifted to the right, primarily because of economic malaise, as you said, but also the immigration being still number one issue. But at the end of the day, I think the democratic systems in France and in Germany are flexible enough to accommodate those views. It will make ruling the countries a little bit more complicated, I guess. We can see in France, still looking for a prime minister. There's no government, essentially, which actually shows you that the country can run without governments and do pretty well. So similar situation will probably happen in Germany. There will be some accommodation. And these are serious concerns, and there's no short-term solution, particularly for immigration issues. But economic issues, I think we'll need fundamental rethink in Germany, because the car industry is very, very important over there. And we can see that they're really falling behind the Chinese in EVs. They just can't match the technology.
So they left it too late, really, in terms of that sort of head in the sand, in terms of the major manufacturers. And obviously...
And if you see, I just saw this morning, BYD sales increased in August by 30%. In spite of the sort of EV demand leveling off a little bit. But how do you compete with that, with people who actually produce their own batteries, who have fantastic technology, great platforms, and are very competitive in price?
We're starting to see them all around the streets of Dubai, and I'm looking at one myself. Omar, looking at this question of that Shoaib brought up there, OPEC plus appetite for, our strategy to think more now about market share rather than price. And I wanted to get your sense of where is Saudi Arabia on that at the moment. We've seen the Saudi government facing a bit more fiscal stress. They've cut back on some of the great ambitions of the 2030 vision with some of their giga projects. They're running a deficit and the fiscal deficit. So your thoughts on where Saudi might be fiscally they pull back the spend so they can accommodate maybe less oil revenue, or will the opposite? They'll want a lot more. Your thoughts on where Saudi's at, market share versus price?
First of all, I agree with the sentiments regarding the Chinese economy, but I think that the wild card here is the US economy, and in particular, whoever gets elected. I think after the elections, we're probably going to see some sort of, with interest rates coming down, some sort of fiscal expansion and a mini boom in the US economy, which could give the world economy enough of a boost. And this relates to the poll question you put out as well. So I think that in Saudi Arabia, regarding OPEC and the weakness in Chinese demand, everyone's waiting to see what happens in the US elections and what that could potentially imply for global demand. And then after the US elections, then we'll probably be looking to settle into a new pattern regarding global oil demand, global oil supply. And that's when, so I guess Saudi Arabia is deferring the decision for now. Until we see, I'm sure if Trump gets elected, he will be, go on a spending spree in the first few months, and it could really have a positive impact. And then also, we who knows what might happen in Eastern Europe or in the Middle East regarding the wars that are currently going on there, and if those are resolved, somewhat amicably, then perhaps that could have a positive impact on the global economy. So I think, in answer to your question, there's enough transient uncertainty that Saudi Arabia will not really be looking to take a position on market share or any other factors for the time being, and will probably be deferring until January, February, and making a decision then. In the meantime, they'll want to continue their sort of low-profile leadership of OPEC and keeping everyone on side, and preparing for the future. And I think that, you mentioned the fiscal stresses. I think that's vindication of the importance of, continuing with Vision 2030, because no matter how adroitly Saudi Arabia and its partners manage global oil markets, the reality is that the future, Adi mentioned the BYD numbers, looks greener in terms of energy and gasoline consumption. And so all the more important that the alternatives are up and running. And in that vein, we saw last week big legal reforms in Saudi Arabia, maintaining this sort of institutionalization of the economic diversification process. The big difference between what Saudi Arabia's position now and say 20 years ago, or like after the 80s oil price shocks, is that for the first time we can say that economic diversification has been genuinely institutionalized throughout all parts of Saudi's government, and so
it's not a fly in the pan thing. It's
anchored
in. It's anchored
exactly.
in. Let's get the survey result to give Shoaib the last word here. So bullish to no impact. Shoaib, wanted to get your views. We have you, obviously. Algeria was looking to be one of the big winners of Europe's turn away from Russian gas. Now that the gas or the energy crisis at least appears to be past, has Algeria won? Can it still win? Your thoughts now, 2 or 3 years later, does Algeria still have a win to get here with European gas, or have the Americans gobbled up that market with LNG?
Yeah, I believe there is no winner in the war, even in the oil and gas market. But I think there is a gap. And Algeria is trying to do its best to fill up the gap, to bridge the gap, I believe, in natural gas in Europe. But what I think at the moment is Europe succeeded really in the last 2 years how to get more natural gas and LNG from the US. We can say that US, yes, was the biggest winner of that war, because it succeeded to increase its LNG supplies to European Union. And the US at the moment is the biggest supplier of LNG to United States. United States at the moment, yes, has very big production of natural gas and has big capacities and has technology also to increase its production. Algeria, yes, it has natural gas, but it hasn't enough capacity to supply the European Union. But Algeria did very good things with European governments. They were looking for natural gas from Algeria. And Algeria at the moment, its natural company, Sonatrach, is investing more than $50 billion in the next 5 years. And this is one of the investments is going to natural gas, because natural gas at the moment is really, many countries at the moment are switching or shifting to natural gas. As we say, or many organizations in the world are putting pressure on CO2 emissions and from coal and oil, and that they are switching, let's say, shifting to natural gas. And I believe Algeria is positioning itself as one of the crucial and the big players in North Africa, and to supply natural gas to the European
Yes.
Union it was, let's say, for decades, and will continue its planned strategy to increase
do so.
its supplies to European Union.
We have to jump in and close it out, because we've gone a little bit over time today, but really great to have your insights. There's certainly a weaker oil price nearly acts like an interest rate cut of its own. And then if the Fed come in with an actual interest rate cut, you would imagine that double offer gives the US economy even more wind in its sails. These where that goes from an oil price point of view. It's sort of like, in some ways, a negative and a plus and a minus. Let's wrap it up there. Thank you so much for joining us this morning. Our great three guests: Adi Absirovic in London, Omar El Baidli in Bahrain, and Shoaib Boutamin in Algeria. Thank you so much for your time and for coming back for this season. We look forward to seeing you all soon again. All the best.
Bye-bye.
Okay.
Thank you.
Bye.